We've had a good question about the difference between the Fed's neutral rate and the Fed's terminal rate, and what difference, if any, does it make? Well, it's a great question. And it does make a difference. So, first of all, let's look at them. What's the neutral rate? There is this interest rate that's usually called the R star rate, and it's the rate at which monetary policy is seen to be neither stimulating nor restricting, a kind of perfect point. And it's the level that the Federal Reserve projects that will keep output growing around its potential rate in an environment when employment is still full and inflation is still stable. Now, the Fed tried to project what this neutral rate is. The Fed doesn't know what the neutral rate is, it just tries to project it, and it's obviously trying to make assessments all the time. Now, if there was a lot of talk about this R star rate, the Fed's neutral rate, ahead of the Powell speech, later speech, the Jackson Hole Symposium, and it's an important rate because it lets us know what the Federal Reserve is thinking about the future path of US economic growth and the future path of inflation. So, if the R star rate, the neutral interest rate, was revised higher, what does it tell us? Well, it tells us that the Fed's more concerned about rising inflation than they have been previously. And in the current context, if the neutral interest rate was revised higher, then we'd see yields move to the upside, we'd expect stocks to move lower, and we would expect the dollar and dollar yen to gain. So that would be if the Fed's neutral rate is revised higher. Now, Powell, didn't make any adjustments to the neutral rate at Jackson Hole Symposium, which was a bit of a relief for those who were concerned about that sort of high inflation narrative developing into a more restrictive Fed policy. Now, the terminal rate is different. The terminal rate is the rate at which the Federal Reserve expected to hike and not go beyond. And, the terminal. So you can see at the moment, using short-term interest rate markets for the terminal rate, you could also use the Fed's dot plot, but just use short-term interest rate markets because, it's a way of showing changing expectations within the market, whereas the dot plot tends to, it's set and it won't necessarily respond to it can't respond to the data that's come after the dot plot until you hear from the Fed again. So terminal rate now, according to short-term interest rate markets, is about 5.45%. So short-term interest rate markets are saying that's it. There's pretty much no more Federal Reserve interest rate hike. 78% chance that the Fed will not change interest rates on the 20th of September. So the difference between the neutral rate and the terminal rate is quite significant. The main difference is the Fed's neutral rate is a more longer term outlook. And the Fed's looking at things like long-term trends in productivity, long-term trends in demographics, and that goes into the neutral rate in a way that it doesn't impact the more near-term terminal rate expectations.